This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Serezna.
Eric, it was great to have Marco back on the show. Listeners, you're going to find the download link for the post-game trade of the week in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Marco's picture saying, looking for the downloads.
Patrick, Marco made a strong case that Europe's defense spending cycle is far from over. We've seen some recent profit-taking in the sector, but he argues that the fundamental trend is still firmly upward. You've put together a trade of the week that captures that idea. Walk us through it.
Eric, one of Marco's most actionable points was the dynamic in European defense. We've seen some profit-taking in the sector on expectations that a potential ceasefire might cool defense spending. But Marco was clear, Europe's rearmament cycle isn't ending, it's just beginning. Defense budgets are now a political necessity and a long-term fiscal policy. With many of these defense names pulling back, it creates a constructive entry point. So this week, I want to put on a bullish European defense trade consistent with Marco's thesis. Now, the tricky part for our North American listeners is that most of the ADRs for the major European defense contractors don't have listed options, so the trade has to be expressed in a basic Delta One form. Luckily for investors who have access to European markets, the individual stocks and their options are quite liquid. So for this week's trade, I want to focus on the largest name in the European defense complex, Airbus, trading on the Paris exchange. The stock has already seen about a 16% peak to trough correction, which sets up a tactical opportunity to position for a resumption in the broader bull trend as we move into the first quarter of next year. I want to be long the stock here, but to use a golf analogy, I'd like to pay a small price for a mulligan, something that softens the drawdown if my initial timing is early. One way to do that is by overlaying a bit of downside convexity. In this case, with Airbus trading at $198, you can look at the January 190 to 170 bear put spread, a 20 euro wide structure trading around €3. If Airbus has one more leg lower before the potential bull trend resumes, any profits from the put spread can be used to reduce the cost base of your longer term position. It's simply a way to stay constructive while being honest about the near term tactical risks.
That explanation worked for the pros, Patrick, and of course our retail audience already knows they can get the full briefing by attending your Monday webinar, which always dissects the trade of the week in detail. And since we've gotten a lot of positive feedback on the trade of the week segments that we've been doing, Patrick has decided to expand on the idea. Patrick, what do you have in mind?
Yeah, Eric, the response has been fantastic. So in 2026, we're turning this into a full-blown initiative. It's called the Asymmetric Trading Challenge, and the goal is simple: to help serious traders master asymmetric setups in real time with real guidance and real accountability.
Okay, so this is more than just a few good trade ideas then.
Much more. It's an entire year-long challenge. Live training, trade breakdowns, a full system to help you protect and grow your capital in any environment. We're going to give you everything you need to level up.
So where do people go if they want to find out more?
You will find the link in the Research Roundup email, or just head to bigpicturetrading.com/challenge to sign up. We're doing a special live webinar on Tuesday, December 16th at 4 p.m. Eastern Time with all the details. Again, that's bigpicturetrading.com/challenge. If you're serious about trading asymmetric risk like a pro, you won't want to miss this. All right, Eric, let's dive into the equities.
Since November 21st, the S&P has traded above its 5-day moving average, implying strong upward momentum, and we're back above all the longer-term moving averages, including the 50-day moving average. So now the question is whether this market can Santa rally its way all the way up to new all-time highs by year's end. I'm on the fence about that one, Patrick. It looks good so far, but the stochastics are already topping out, short-term oversold, so it's probably time to dip below that 5-day and see what happens. And I think that's the key, is what happens if we get a little bit of a dip below the 5-day. Is it another rollover back towards another correction or a deeper correction, or is the 50-day moving average going to hold this time? I think it probably will, but to my thinking, that's the key, is the 50-day going to hold? If we go back down from here and test it, it's fine with me, as long as we don't close below it. If the 50-day does hold, I think we have a good shot at a nice Santa rally from here, but I'm not betting on it.
Well, Eric, in my mind, the S&P 500 has now officially had its correction. We've been talking about for months that we were overdue for a 5+% correction. Well, we got our 6% correction. A lot of metrics were quite oversold. And now that the market has resumed back to its highs, there is an equal chance that this market can actually break out to higher highs, as it is that this is a bigger topping formation. Now, what will be the deciding factor is what happens in the middle of the month. We have the much anticipated FOMC meeting and press conference, as well as the delayed jobs numbers releases that are going to give a really good sense as to whether the Fed is going to have to be on a dovish pivot in order to keep the economy going. So my positioning for the next week really is that the market is going to stay in this holding pattern at least for another week. All the information is going to be released in the middle of the month. And so very likely the overhead resistance will be its highs, which is within 100 S&P points. And there's no reason for us to, at this point, dip back below the 50-day moving average till we're past that data point. And so the next 1 week is far more likely to be trade range bound. And we're going to really see what the bulls have in store once we get past those major news events and whether there's going to be a Christmas rally in the final few weeks of the year. All right, Eric, let's touch on that dollar.
Well, the short-term trend line that's been in place since late September or so has broken to the downside now, but only by a little bit, and that downside break did not seem to bring on an acceleration to the downside. It didn't bring on more momentum down. So I think we're still on the fence here between continued consolidation and upside breakout on the Dixie chart. My prediction is that the outcome will ultimately be headline-driven, and Trump and Bessent's next moves are probably going to decide the next leg.
Well, it is important to note on the dollar here, Eric, that this is the first close below the 50-day moving average in months. So there was, for months, an opportunity for the U.S. dollar bulls to actually get something going on the upside, including against that U.S. dollar yen. We saw an extraordinary rip to getting it within a stone throw of its previous year's highs. And so there was this big dollar impulse already. So with it all rolling over, the question really now becomes, is Marco's view on the dollar going to be the one that prevails? Is this breakdown potentially going to start there? There's a lot of implications, because if the dollar resumes selling on the downside, it means the reflation trade is still on, and overweight into emerging markets, international equity, and into commodities becomes a big theme. And so watching whether or not this close below the 50-day moving average is something more than just a one-day dip is definitely the thing to watch. All right, Eric, let's touch on crude.
Cushing inventories are now at operational minimums, yet backwardation at the front of the WTI curve is muted and only lasts for the first 4 months out on the curve before it flips back into moderate contango. So my outlook is unchanged. I think the fundamentals are decidedly bullish, but I also see room for invisible hands to keep oil prices low through the midterm elections, as I discussed with Marco in the feature interview.
Well, Eric, crude oil has been selling for almost 40 days now, and it has failed to have any acceleration to the downside that has broken it to a lower low. Now, we still have a couple of news catalysts, like a potential peace deal between Russia and Ukraine and or the outcome of the Venezuela escalation. But overall, oil has held in very well. And so at this moment, there is divergent momentum from things like the momentum indicators, which is showing that the downside momentum has dissipated and in fact actually reversed. So with the fact that many energy stocks are actually taking good positive flows, I'm speculating here whether or not oil is capable of actually closing above $60 in the coming weeks. If we see a weak U.S. dollar with a crude oil breaking out higher dynamic, that could spur a new bull breakout. But as of this moment, it's not a bull breakout. Oil is still in its primary downtrend, still holding below the 50-day. So this is early speculation as to seeing whether or not we're going to see a turn point here in the week to come. Eric, gold's been moving. What are your thoughts here on it?
The formative breakout from the symmetrical triangle formation that we discussed last week completed to the upside with vigor. So exactly as we expected, looks like the bull move might be back on. But now the very short-term slow stochastics have run from oversold back up to short-term overbought, and they've already started to roll over. So I think gold is taking a little pause here. The question is, how long and how deep of a pause? Is it just going to tread water, or is it going to take a dip here? If we can get to new all-time highs, the measured move targets are in the 49.30 to 51.20 range, depending on which bottom you measure that last move from. So the question is whether or not this correction is fully over, and I think it probably is. But with the stochastics already rolling over, I think we could see a dip in the next few days before that rally resumes.
So, Eric, gold's consolidation has been now going for 45 days. I was highlighting that the previous 4 corrections in gold consolidated sideways, and they were anywhere from 2 to 4 months in length. So if gold broke out here, it would have been the shortest correction that we've seen. But we are bullish and we're looking for bull continuation. What is one positive sign is that on page 7, I have that chart of silver futures, and silver has already broken out of the pennant to the upside and is actually ripping higher with a lot of momentum based on silver shortages. At the same time, the gold miners have already broken to higher highs. And so we have a lot of momentum coming in here. Platinum and palladium also starting to turn up here. There's a legitimate chance that in the month of December, we will see gold attempt to break out to an all-time new high. Will we see that breakout here in the next week? Or is it going to be one of those things that is going to happen after the FOMC and the jobs numbers release later in the month? I'm speculating more on the later in the month kind of scenario where we'll already be at a 2-month phase of this correction. But I am bullish on gold. This is just a matter of timing of when some new bull run can really get underway here. Eric, what are your thoughts here on uranium?
Well, Patrick, I couldn't possibly be more bullish about uranium and uranium miners long-term. The long-term fundamentals couldn't be better. But in the short to intermediate term, I'm getting a little bit nervous about this chart. The uranium miners are looking, well, kind of dead cattish to me. The S&P is rallying like the correction never happened. We're maybe headed toward, new all-time highs. But URA and a lot of other charts in the sector look really dead catty. Yeah, they're recovering. The direction is up. But they still haven't even retraced as much as a 38.2% fib retrace on the correction. And the short-term stochastics have already run back up to short-term overbought, implying that maybe a dip or consolidation's in the making. If that happens, and particularly if there's any broad market weakness to accompany it, we could see a new lower low here. If that happens, I say it's still a buy the dip opportunity. The thing is, I don't know how far it's going to dip or how long it's going to dip before we see a solid resumption. I don't know why we haven't seen that resumption. I was expecting it in sympathy with the S&P. Oftentimes, uranium will bottom before the S&P and it will recover before the S&P. Now we're lagging the S&P when we should be doing the opposite. So I'm getting a little bit nervous about this chart short term. But again, whatever happens bad to the downside in the short term, I see as a buying opportunity.
Well, Eric, when looking at the chart on page 8 of the uranium futures, overall, uranium's just been consolidating and it could easily bullishly break out. But on the topic of uranium stocks, well, they have now officially corrected 50% of the prior rise. And so while there's no evidence yet of a bull continuation pattern getting underway, we've already seen a deep enough correction for inevitably buy on dip traders start to defend these areas here. And so, while maybe a breakout in uranium is not imminent, I do think that these are price levels that are interesting and certainly a level that I think is worth watching here. Now, Eric, we haven't touched on copper in a while, but we just had a fresh breakout. How do you size this up?
Well, Patrick, the big move up to new cycle highs on the U.S. high-grade copper futures chart pales in contrast to the much greater action on the LME, where copper demand for the physical metal has been staggering. Goldman Sachs has a note out saying that this is probably all about Asian demand, with the immediate apparent buyers being Taiwan and Korea, but Goldman speculates in their research note that it's eventually all winding up in China. Given the growing tensions between China and Japan that Marco highlighted in the feature interview, this, I think, is going to be an important signal to watch.
Well, technically for me, it's a pretty significant breakout to higher highs. I have that chart on page 9. It's significant because it has broken all of its previous highs other than the tariff bump, which was then removed out of the market. So if it wasn't for that tariff volatility, this would have been a break to 52-week new highs. Now, copper is measuring out for a test of like the 575 level on the upside. So it retesting that July high that was caused by the tariff bump is 100% on the table. Definitely a bullish breakout. All the copper plays are getting going. And so copper is definitely a hot place to be right now.
Patrick, before we wrap up this week's show, let's hit that 10-year Treasury note chart.
We have seen Treasury yields kind of settle in. The interesting part for me is how much will a potential dollar breakdown play into determining the short-term trend of yields. Now, we have seen that 4% level more or less hold at this stage. We're hovering right at the 50-day moving average and the descending trend line. So seeing whether or not yields can break higher from here is going to be a big technical signal. And we'll be watching whether or not there is going to be a pivot here on what's been generally a pretty bullish Treasury bond market for the last 6 months. Will that all end with higher yields?
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.